Your future wealth is slipping away. Today I will show you how it is happening and what you can do to put a stop to it. Hello fellow human, nobody here. We investors make many mistakes, some big, some bigger, and we are often not even aware of it. As the saying goes, out of sight, out of mind. This makes life so much easier, but an easy life was never a great life. Today I will explain 10 huge mistakes you may be making as an investor. 10 things for you to stress about and fix. Take into account that some of the information I provide may not fit your specific context. So no, this is not financial advice. This is just how nobody invests. If you enjoy this type of content, please like and subscribe. It really helps a lot. Let's begin. Mistake number 1 is obviously not investing in the first place. There are many different types of investment, and preference for one or for another varies across geographies, cultures, and depending on how developed economies are. Despite the multitude of options, many people do not know their money should be working for them. There can be many reasons for this, but deep down, the main culprit is ignorance. Some people don't know what investing options there are, and other people have distorted views on some or all of them. Mistake number 2 is not putting your money in the right places. The evidence is clear. Stocks are the best long-term investment for 2 main reasons. First, stocks have the highest long-term returns, period, as proven by many decades of evidence. Second, stock returns are based on the performance of the underlying companies and not on the expectation that people will pay more for the shares in the future for no apparent reason. Unlike other investments, in the long term, a stock goes up because the underlying company makes more money that can potentially be distributed to investors as dividends. Since the value of stocks is based on tangible value creation, the earnings generated by companies, investors can rest assured that the value of their investment will not just go up in smoke unless the company itself really performs terribly. Obviously, there are low-quality companies and even scams among stocks. You should not pick stocks blindly, just like you should not buy a house without taking a close look. Mistake number 3 is thinking slower is better. As I explained at length in my previous video, many people confuse slow with reliable. To keep it short, let me put it bluntly. For most people, growth stocks are great and dividend stocks kind of suck by comparison. What matters in a stock investment is the total return, which is the combination of the share price growth and the dividend payments. For stocks with high total returns, most of the return comes from the share price growth, which depends on the earnings growth, which is much faster for growth stocks than dividend stocks. Volatility is higher for growth stocks, but volatility is only an issue if you plan on selling shares within a short period of time. For these reasons, growth stocks are the way to go for most people, who should be long-term investors. But this is just the short version. If you'd like to know more, I explain it in detail in my previous video about dividends. Mistake number 4 is not analyzing stocks well. Just because growth stocks in general have great long-term returns, it doesn't mean anything called growth is great or that you should pay any price for them. You should make sure that their future growth estimates look solid and that their valuation is not too expensive. Take into account that valuation is relative and multiples should be higher for a company growing faster. And remember that you should only care about forward multiples, since stocks are priced according to the future of their companies. You also need to see what are the margins for the business. The higher, the better. Personally, a gross margin below 30% is a red flag, and I would only buy if I can expect the margin to increase in the future. Mistake number 5 is paying too much attention to share price charts. The trend of the share price by itself, the momentum, doesn't tell you whether it is a good idea to buy or to sell. Just because the share price has dropped doesn't necessarily mean that the shares are cheap or that the company is doing poorly. At the same time, shares going up doesn't necessarily mean that shares are expensive or that the company is doing great. That said, a big short-term drop in the share price can be an excellent opportunity to buy shares at a discount. You need to figure out whether the drop is justified or an overreaction. And if the price of a stock you own has quickly gone up, you should make sure it has not become too expensive. If it has, it might be an excellent time to sell. Just don't give too much importance to the shape of the share price chart and focus on valuation and future growth. Mistake number 6 is diversifying too little or too much. Diversification is how we protect ourselves against ignorance. If you knew absolutely everything, present and future, you would be able to pick just one stock. The one stock you knew with certainty had the highest, most reliable potential. But because the information we have is never complete nor perfectly accurate, there is a chance for each one of our stocks to do much more poorly than we expect. For this reason, we pick several stocks, and for each stock that does worse than expected, there likely will be others that make up for it by doing better than expected. However, when we buy stocks, we first buy the ones we perceive as highest quality. If we pick many stocks in a hurry for the sake of diversification, we will likely be including stocks that are less than top quality. Don't get me wrong, you can definitely buy a large number of stocks and still have excellent returns. You just need to be careful not to include suboptimal picks for the sake of diversification. If you buy many stocks, it should be because every single one of them looks excellent by itself. Mistake number 7 is thinking economic forecasts can help you. No one can predict the future, least of all economists. And even if they could, how is that going to help you? By the time you learn about the probabilities of a recession, or the impact of a pandemic or a war on the economy, the market will already have priced it all in. Understand you cannot compete in speed and focus on picking the stocks that will do best in the long term. If you must learn about geopolitics and macroeconomics, don't do so out of the expectation that it will help you improve your investment returns, because in fact, it can cloud your judgment and make you more prone to try to time the market, which is gambling. Mistake number 8 is selling your winning stocks for the wrong reasons, such as because their returns have reached an arbitrary percentage. Just because the share price has gone up by 50% or even 100% in a short amount of time, it doesn't necessarily mean it is time to sell. Even if the stock has doubled in a few months, it may have just gone from very cheap to cheap, in which case you should probably still hold it. As I keep mentioning, you should be making these decisions first and foremost based on the valuation of the shares and the future growth of the company. And even if you already do so, you might still be selling a bit too quickly once valuation is not so cheap anymore, which takes me to my next point. Mistake number 9 is paying taxes on your capital gains earlier than you need to. When you sell a stock that is in the green, you will turn unrealized gains into realized gains, and you will most likely need to pay taxes on those. Although it might not be very intuitive, even if the tax percentage is always the same, the timing of taxation matters a lot. Later is better, because what you pay in taxes now is money that cannot work for you anymore. But gains that remain unrealized and untaxed will continue to fully compound for you. That said, selling a winner can be the right decision in 2 scenarios. One, if the stock is clearly overvalued and the risk of a significant share price correction is bigger than the taxes you will pay for selling. And 2, when you plan on moving the money into other stocks with significantly higher upside potential, higher enough to compensate for the taxes you will be paying. Mistake number 10 is not having a clearly defined and consistent investing strategy. While you should be constantly learning and improving your approach to investing, you should not go around experimenting impulsively. You should systematize your decision-making process for buying and selling stocks. having clearly defined goals, criteria, and steps to follow. This will help keep you on a clear path forward and avoid taking actions that go against each other. And also, make sure to write down enough explanations for your future self to understand what led to your actions. This will help both to learn from mistakes and to replicate the methods that prove successful. There will be times when you realize you gave too much or too little importance to one thing or to another. This is fine, it is part of the learning process. What matters is that the whole ship rows in the same direction. You can do so with a well-structured system, but not if you make decisions independent from one another. And this is it, 10 deadly mistakes that can eat at your prosperity like nothing else. To sum up, the way to avoid them is to follow these rules. Invest your money, use stocks as your investment vehicle, buy growth stocks, analyze growth stocks well, give little importance to share price trends, diversify without sacrificing quality, ignore what cannot be known about the world, keep your winners until there is good reason not to, delay paying taxes by not selling too soon, and have an investing strategy. I hope everything was clear. Let me know if you have any doubts. Thank you very much for watching. If you got some value out of this video, please like it and subscribe to the channel to support it and be notified of future content. Also, share your thoughts in the comment section and let me know which topics you would like me to explore in the future. And until the next one, remember, if nobody invests, so should you.